Welcome back to Gold Rush Reporter. I'm your silver analyst, here to break down what's really happening in the silver market. Not the surface headlines, but the real story behind the price moves. If you're serious about understanding where silver is headed and why this moment is unlike any other in the last 4 decades, stay with me till the end of this breakdown. Silver has officially broken its silence. After years of flat trading, it's now pushing toward the historic $50 level. But here's the key point. That number doesn't mean what it used to. When you factor in inflation, silver would need to be around $72 to $73 just to match its 2011 high, and closer to $200 to match its 1980 peak. So even if silver hits 50 again, it's still undervalued in real terms. This is what makes the current rally so significant. It's not just a speculative move, it's a structural shift. Analyst Peter Krauth explained this perfectly when he compared silver's nominal highs with their inflation-adjusted values. In other words, what looked like a record back then is now a discount. He believes silver remains seriously underpriced, and the data supports that view. A major reason behind this setup is the flow of physical silver between key markets. Over the last few months, a huge amount of silver has been moved from London to New York. Normally, silver travels by ship. It's heavy, it's bulky, and time isn't usually critical. But this time, large quantities were flown to the United States because demand was so intense that buyers couldn't wait. That's not normal market behavior. That's a panic to secure physical metal. This movement caused a severe supply squeeze and triggered something rare in the futures market called backwardation. In simple terms, backwardation means that physical silver available right now is priced higher than contracts for future delivery. It's the opposite of how a healthy market usually works. This happens when the near-term supply dries up and investors are willing to pay a premium to get their hands on real silver instead of paper promises. It's a major signal that the paper market, which has dominated silver pricing for years, is starting to lose control to the physical market. And that shift changes everything. It means price discovery is no longer being set by speculators and contracts, but by real-world scarcity. Krauth believes that this tightening in supply, combined with growing investor interest and persistent inflation, is setting the stage for a powerful long-term move. He expects silver to not only reclaim the $50 mark, but to establish it as a new floor, not a ceiling. From there, he sees considerable upside potential as global liquidity continues to flow into tangible assets, the kind that can't be printed or replaced. If you find this kind of detailed breakdown helpful, make sure you stick around. There's a lot more coming up in the next segment as we dive deeper into what makes this silver cycle completely different from the blow-offs of 1980 and 2011. When we look back at silver's 2 previous runs to $50 in 1980 and again in 2011, both of those rallies were fast, emotional, and unsustainable. Prices went vertical, hit their peaks, and then collapsed just as quickly. What's happening now is completely different. This rise has been slow, steady, and disciplined. It may not look as exciting on the charts, but that's exactly why it's more powerful. Steady accumulation signals long-term conviction, not hype. In 2011, the market was driven by fear coming out of the financial crisis. And in 1980, it was dominated by the Hunt brothers trying to corner the silver market. Both were temporary shocks that couldn't hold up once the pressure eased. This time, it's not about manipulation or speculation. It's about fundamentals. Industrial demand, investment demand, and global monetary pressure are all converging at once. The most important change is that silver is no longer treated as just a hedge or a trade. It's becoming a strategic asset again. Inflation expectations are rising globally, even as official reports try to downplay them. The University of Michigan's consumer survey, for example, shows that people expect inflation to be around 4.8% a year from now, while official numbers claim it's closer to 3%. The public doesn't believe the narrative anymore, and that's critical because when investors lose faith in paper measurements of value, they turn to hard assets: gold, silver, real estate, and commodities. Think about it practically. If you own physical silver and you expect inflation to stay near 5% or more, why would you sell? You'd be giving up something that's maintaining its purchasing power in exchange for cash that's losing value every month. That's exactly what's happening. Holders of silver are refusing to part with their metal, and that reluctance is creating a secondary layer of scarcity. When people hoard silver instead of recycling it back into the market, the available supply tightens even further. We've already seen the results. The price briefly climbed past $54 before pulling back into the high 40s. Some traders called it a top, but they're missing the context. The structure of this move, and the resilience of prices even after a pullback, suggests that silver is building a base, not collapsing. The fundamentals haven't changed. The tightness in supply is real, and the demand drivers are only getting stronger. Lease rates, which measure how expensive it is to borrow physical silver, hit 39% the day silver peaked at $54. That's an insane number, and a sign that physical silver was practically unavailable. It's like paying 40% annual interest just to borrow metal for delivery. That kind of dislocation doesn't happen in a balanced market. It happens when physical demand overwhelms paper supply. These signals, backwardation, tight lease rates, and sustained physical premiums, all point to one conclusion. The paper market is losing its grip. Futures contracts used to dictate silver's price because traders could move huge volumes of paper silver without ever taking delivery. But when real silver becomes scarce, the futures market can't pretend anymore. Price discovery shifts to where the actual metal changes hands. That's what's unfolding now. The takeaway is simple. Silver's current rally isn't a repeat of 1980 or 2011. It's the start of a new phase where price is determined by physical scarcity and structural demand. The longer this imbalance continues, the more pressure builds. Eventually, it snaps. And when it does, the move won't just retest old highs, it'll redefine what high means for silver altogether. The conversation around silver usually focuses on price charts, but the real story lies in the supply and demand imbalance that's quietly tightening beneath the surface. For more than a decade, global silver production has been flat. Mining output hasn't increased meaningfully in over 10 years. And recycling, which makes up around 15% of total supply, has also stagnated. That means the world's total silver supply sits at roughly 1 billion ounces a year, with no growth in sight. At the same time, demand has climbed far beyond that level, creating a persistent and widening deficit. Around 85% of global silver supply comes from mining, and most of that is a byproduct of other metals like lead, zinc, or copper. That's a critical point. Miners can't just ramp up silver production because prices rise. They only get more silver if those other metals are being mined aggressively, which depends on completely different economic cycles. In other words, silver supply is largely trapped by the realities of industrial mining. Even if prices jump, production can't respond quickly enough to meet demand. On the demand side, the growth story is explosive. Industrial use now takes up nearly 2/3 of all silver mined. Solar panels alone consume around 200 million ounces each year, and that number is climbing fast as the world transitions to renewable energy. What's more, new technology is making solar panels even more silver intensive. The shift from older PERC technology to TOPCon designs increases the silver content per panel by 40 to 50%, because these panels are more efficient and produce higher energy output. Manufacturers are willing to pay more for silver because the performance gains justify the cost. That's a major turning point. For years, producers were trying to use less silver in solar panels to save money. Now the opposite is happening. They're using more because efficiency matters more than thrift. Add to that the rapid expansion in energy storage. Battery systems, which allow solar power to function as a reliable energy source, even when the sun isn't shining, are being deployed at record rates. Battery installations in 2025 are projected to be 60% of 2023 solar capacity, and that growth curve is steep. Batteries and solar are connected in a feedback loop. The cheaper and more efficient batteries become, the more valuable solar power gets, and by extension, the more silver the world consumes. Together, these two sectors are creating a constant and growing floor of industrial demand that isn't sensitive to short-term price changes. You can't build renewable infrastructure without silver, and governments are pouring billions into these technologies. That ensures that industrial buyers will keep absorbing silver even as prices rise. Meanwhile, the investment side is waking up. The largest silver ETF, SLV, has shown signs of bottoming and accumulation since mid-2024. Its total holdings have been climbing again after a long period of decline, signaling that institutional investors are quietly rebuilding their positions. Bullion dealers are reporting shortages and back orders, especially in Asia and the Middle East. In markets like China, Singapore, and Egypt, people are literally lining up to buy bars and coins. This combination of flat supply and accelerating demand is exactly what drives long-term bull markets. You can't print silver. You can't fake physical ounces. When you have an asset that's becoming rarer each year, while new industries depend on it more than ever, the outcome is predictable. Higher prices. What we're witnessing right now isn't a speculative pump. It's a structural realignment between silver's real-world value and its outdated paper price. And this imbalance hasn't even peaked yet. At this point, the imbalance in silver isn't just visible. It's becoming undeniable. Every metric points to a tightening market that's fundamentally incapable of meeting growing global demand. The Silver Institute estimates total yearly demand at roughly 1 billion ounces, but that number doesn't capture the full picture. When you include ETF inflows, institutional hoarding, and private accumulation, real demand is much higher. And that's where the cracks in the system start to show. The Silver Institute, for example, doesn't count silver held in ETFs as consumed because technically it can be sold back into the market. But that logic is weak. Physical silver held in vaults, whether by investors, funds, or central banks, is functionally removed from circulation. It's not available to satisfy industrial or retail needs, and it doesn't flow back into supply unless prices spike hard enough to shake it loose. The same argument could apply to coins and bars, yet those are included in demand numbers. That inconsistency alone shows how understated the official data really is. If you adjust for ETF holdings, the market deficit becomes one of the largest in the last decade, potentially the third biggest in 10 years. That means more silver is being consumed or locked away than produced year after year. A deficit of that scale is unsustainable. Eventually, the only way to rebalance it is through price. Higher prices attract more recycling, push marginal mining projects into production, and discourage speculative short selling. But until that happens, the market stays squeezed. And we're in that squeeze right now. Industrial users can't simply cut back. Electronics, solar panels, and electric vehicles all need silver to function. There's no substitute that matches silver's conductivity and durability. Jewelry demand, which takes about 20% of total silver each year, is steady, even at higher prices. Investment demand adds another 20% or more. That leaves practically no spare capacity. Once investment capital starts flowing back in aggressively, it's going to collide head-on with the industrial sector's fixed needs, forcing a price breakout. We're already seeing early signs of this pressure. Bullion dealers report thin inventories, delayed shipments, and rising premiums. Even large-scale buyers are struggling to secure supply without paying above spot prices. When that happens, it means the paper price no longer reflects the true market reality. And that's the point where the futures market begins to lose credibility. For decades, silver pricing has been dictated by paper contracts. Massive leveraged positions traded by institutions who never touch the physical metal. But that illusion only holds as long as there's enough silver available to back those positions. Once physical shortages grow, the paper market has to follow the real price or implode, trying. This transition from a paper-driven to a physically set market is exactly what Krauth and other seasoned analysts have been warning about. The same pattern shows up in every commodity that goes through a structural supply shock. At first, investors don't believe it. Then premiums rise, inventories vanish, and suddenly everyone scrambles for real ounces. Silver's in that early to mid stage right now. The long consolidation is ending, and a repricing phase is beginning. If silver maintains even a moderate deficit for another year or two, the upward pressure becomes exponential. Remember, mining can't react instantly. It takes years to open or expand a mine. Recycling can fill a small gap, but it can't cover a structural shortfall. That's why the setup looks so strong. Limited supply response, growing industrial consumption, and the return of investor demand all converging. The takeaway is simple but powerful. Silver's not just another trade anymore. It's a reflection of real-world scarcity colliding with monetary distortion. The next major leg higher won't be a speculative spike like in 2011. It'll be a repricing that resets how the world values silver altogether. When you connect all these dots, the inflation-adjusted undervaluation, the growing industrial hunger, the stagnant mine output, and the shift toward physical price discovery, the message becomes obvious. Silver isn't just recovering, it's being revalued. For decades, its price was suppressed by paper markets that never had to deliver real ounces. Now, those same markets are being forced to face reality as physical demand outpaces available supply. This is the kind of fundamental realignment that only happens once in a generation. What makes this moment especially powerful is how broad the demand base has become. Industrial buyers are not slowing down. They can't. Solar, batteries, and high-tech manufacturing all depend on silver's unmatched conductivity. Jewelry and silverware continue to absorb around 20% of total production, and investment demand is accelerating. Add it all together, and you have a world consuming more silver every year than it produces, with no quick fix in sight. That imbalance is the foundation of the next major bull market. Meanwhile, investor psychology is shifting. People are realizing that the official inflation numbers don't match their real-life experiences. They see costs rising faster than the data admits, and they're losing faith in fiat currencies. When trust in paper erodes, tangible assets regain power. That's exactly what we're seeing now. Silver, gold, and other hard assets aren't just hedges anymore. They're lifeboats in a monetary system that's leaking credibility. As silver continues to hover near the $50 mark, most retail investors are still sitting on the sidelines, waiting for a clear breakout. But the truth is, by the time the mainstream crowd recognizes what's happening, the easy gains will already be gone. The current levels, with supply so tight and industrial demand guaranteed, may turn out to be the new cheap prices when we look back a year or two from now. Even conservative analysts like Peter Krauth believe we're entering an era where the physical market dictates the trend, not the futures exchanges. Once that dynamic becomes permanent, the revaluation will accelerate. Silver could very easily push well past $70 or $80 before the broader market catches up to the fact that the world's stockpiles are shrinking. And if inflation continues to run hotter than reported, even a $100 silver target might end up being conservative. So the strategy here is simple. Stop thinking short term. This isn't about chasing a quick breakout. It's about recognizing a slow motion reset of how value is defined. When currencies weaken, debt expands, and physical assets tighten, ownership of something tangible becomes a strategic position, not just an investment. That's where silver stands today. It's no longer just another commodity. It's the measuring stick for real value in a distorted financial system. If you found this analysis useful, hit that like button and share it with other investors who follow gold and silver. Make sure you're subscribed to Gold Rush Reporter so you don't miss the next breakdown, because we'll be tracking every major move as this historic shift unfolds. Stay alert, stay prepared, and as always, keep stacking physical.